Hello everyone, and welcome to this special webinar. It's Fringe Benefits Tax time of the year, and I thought I'd do this video. This is mainly for my clients to, get them in the mood for doing an FBT return and letting them know what needs to be done prior to getting this done this year. So just a quick disclaimer, make sure you do get your own advice. So particularly for my clients, get some advice from me. The first thing we need to address with fringe benefits tax is motor cars. Now, this video is not going to be talking about all those other FBT things like car parking and entertainment, things like that, because basically for my clients, it all comes down to cars. Like, between you and me, most of those things, the entertainment type expenses can be, put away to staff amenities or something like that. But motor vehicles, we've got to do something about that. And the first question you need to ask is, does your company own a car? Because if you say yes, we now need to prepare, or at least and lodge, a fringe benefits tax return. I'll explain why as we go through. Now, I've done plenty of videos on fringe benefits tax. One in particular I did there was that ATO warning FBT and company cars. So if you haven't watched that one, I really suggest you go back and watch it, because what they're saying there, the tax office saying, well, they are putting motor vehicles and small businesses on the radar because they believe they are being missing out on about $1 billion worth of tax revenue from people not declaring motor vehicles owned by company cars and paying FBT on it. So that's their big focus this year. And the reason is because the tax office got a little bit smarter. They've got into data matching. So what they've done, they've gone back to Services Australia or Services New South Wales or the Office of State Revenue, whoever in your state looks after car registration. And they've asked them to give them details of all the motor vehicles that is owned by a company. And they've gone back at least 5 years, probably longer than that now, because they did this like 12 months ago. Now they have all that data. They now know what motor vehicles are owned by companies. Go back and watch that video, because what they're saying there is that they're probably not overly concerned about the utes and the vans and the trucks and things like that. But what they are after are sedans, and particularly luxury sedans that are owned by companies. That's their number one focus for this year. And what I was saying in that video, if your company owns a motor vehicle, you need to do something about it. And you need to do at least one of the following two things. One is, in item 6.1 of the company's tax return, you need to show an FBT employee contribution. I'll explain what an employee contribution is a bit later, but you need to do that. It's basically, instead of paying FBT to the tax office, the employee, in most cases it's the directors of the company or their family, make a contribution back to the company to cover their private portion of their running costs. So that's their contribution back to the company. And that's income for the company. And that needs to be shown as a separate item at 6.1 of the company tax return. It shows FBT employee contribution 6.1, and you need to put something there. Or you lodge and prepare an FBT return, because that's the opposite. You could actually, no, I'm not going to make an employee contribution. I want to pay the FBT tax. Most people won't. Most people will go for the employee contribution. But if you watch my videos, it works out very, very similar which way you do it. So if you have a motor vehicle in your company, you must do something. You must prepare and lodge an FBT return. Now, even if it's zero, like you might own just a ute, that's all it is. But the tax office have changed the rules regarding the utes and vehicles that are designed to carry a load. We'll go through a slide of that later. It's not just exempt anymore. So as a result, the tax office don't know that you're not using that for private. They might see you own a ute probably not going to be too excited about it, but we still need to address it. We still need to either lodge a tax return that says 100% of it was work and lodge that FBT return. Because if you don't do anything, knowing the tax office, they're a suspicious mob. So that's what I'm saying is if you own a car in the name of your company, I guess, or a trust. I talk about companies, but I do also mean trusts as well. A lot of people run their businesses through a family trust or a unit trust. You have to do something now. You can't just ignore it. A lot of people say, that's okay, Derek. I've got, a ute and it's not subject to FBT, but the tax office don't know that yet. So that's the number one thing that came out of that video, and that's what it's all about for this video. A couple other important things is people don't realize this, but fringe benefits tax is a completely different year to income tax. It actually runs from the 1st of April to the 31st of March, as opposed to a financial year, which usually runs from the 1st of July to the 30th of June. So as a result, it's a completely different legislation. It's a completely different return. It's an FBT return as opposed to an income tax return. So I guess what a lot of people really should get into the habit of doing, where you have your company tax return that's due after June every year, and you've got your fringe benefits tax return, which is due after March every year. You just got to do both of them, unless you're someone who just doesn't have an FBT-able item, which is like a car or anything like that. So again, the first question is there a motor vehicle that is owned by your company? Yes or no? And if you don't know, we'll go and look at the registration papers to see whose name is on the registration paper. If it's yours, we don't need to worry about it. We'll deal with that differently, because then the car expenses can still be being paid by the company, but it'll pay that to you as an allowance. You show that as income and show all the expenses then in your personal tax return. Another video has been done on that one. But if you have a motor vehicle that's owned by the company, you need to do something about it. The other important thing here is that the tax office does make a distinction whether the car is taken home at night. So if you have a car that's available for your employees to use during the day, but they have to leave it at the office or the factory or the warehouse overnight, that's something that probably is still exempt. But we still need to let the tax office know that. So I'll show you how we do that later. So basically, if you say yes to those things, and most people will, we need to prepare and lodge an FBT return, whether you like it or not. I know a lot of clients go, no, Derek, I just don't want to do one because my vehicle is exempt. The problem I have is the tax office don't know that. We need to let them know either by a mechanics of either doing an FBT return or showing an employee contribution and still doing the calculation on that. Now, in most cases, now say last year we lodged 50 fringe benefits tax returns for clients, 48 of them were nils, nil tax payable, FBT payable. And the reason is, doesn't mean there's not an FBT liability there, is because most cases we'll do an employee contribution. So what happens is, let's say we work out the FBT liability is $20,000. So therefore, instead of them paying FBT on $20,000, which is 47%, but you do get tax deduction for it, so it works out about the same, the employee then makes a $20,000 contribution, which is then taxable at 25% for the company. So that's what most people do. In one of my videos, I actually did the calculation. It's slightly better to do the employee contribution for tax purposes. But we'll still do a nil return, even though I've done all the calculations for it. Why do we do a nil return? Because the tax office then say, well, because of the statutory limitations, when you lodge something like company tax returns, individual tax returns, FBT returns, there's a statutory limitation on how far the tax office can go back and audit that. And FBT returns, it's 3 years. For company tax returns, it's 4 years. Individual personal returns, it's 2 years. Things like that. So once we lodge the FBT return, say we lodged it today. So let's say we lodged it the 1st of April, 2024. So therefore, in 3 years' time, the tax office can't go back any further. What they can do, though, is they can go back and look at previous tax FBT periods, like the 22 and the 23, and the 21, because if you've never lodged an FBT return, then that's still fair game for them to go back, particularly now with information regarding, their cars going back 5 or 6 years. This is what the tax office will be doing. They'll be going back multiple years. But at least if we lodge a tax return nil now, the period of time is then at least ticking. We get like in 3 years' time, we can not worry about it anymore. So that's why I encourage a lot of people, even though they might have one motor vehicle, which is a ute. So it's when we go through the calculations, it might even not be subject to any employee calculations or anything like that, but it's still worth lodging a nil FBT return. One is because we've shown the tax office that we've done the calculation and it is exempt. And secondly, that whole 3-year period starts, and it gives us some peace of mind. The tax office won't go back many, many years later and dig up the past. Okay, so this is the flowchart I did in one of the other videos. So basic cars are in 3 categories at the moment. The first one is these FBT exempt electric vehicles. A number of clients have been buying electric vehicles, which is great for Fringe Benefits because they watch my video on that one. Now, there are some exclusions. So you have to make sure the cost of that car, excluding GST, was less than $84,916, and it was purchased brand new for the first time after the 1st of July 2022. You tick both those boxes. You have unlimited private use for FBT purposes. So basically it's 100% FBT exempt, which is great. That's why a lot of people are buying electric vehicles, because you don't need to worry about any income tax consequences or FBT consequences of that. All the running costs, all the depreciation, everything of that car is a tax deduction for the company. You don't have to worry about the private portion of it. Having said that, though, we still need to do an FBT calculation. And the reason is because this thing called reportable fringe benefits tax. I'll do a slide on this in a minute, but it's basically, it's the employee or the director is getting some form of benefit, and fringe benefits. Now, there's no FBT tax for the company. However, the reportable fringe benefit still needs to be included in your personal tax return. Not you pay tax on it, but it gets calculated for a number of things. And I'll do a slide on that in a minute. Okay, so FBT exempt vehicles like electric cars, we still need to do a calculation on it. The second type of car is this one designed to carry a load. Now, those ones are utes, vans. I've done a whole video on this. It's basically if the car is designed to carry more of a load in kilograms than it does in humans, even the 5-seater utes work out to be carrying, ones that are designed to carry a load, you're okay. Now, prior to 2019, that was just a blanket exemption for FBT. If you had one of those, you didn't have to, it was like an electric vehicle is now. You didn't need to worry about the FBT component of that. However, it all changed in 2019, where they put this limited private use clause in. It was like a tax ruling that came out. So basically, you now have to, I'll go through this again later, is if you've got a ute or a van or anything like that, and you use it during the year for more than basically 1,000 kilometers of private travel, you now need to do a logbook and all those other things on it. If it's less than 1,000 kilometers, no problem at all. It remains exempt, and therefore no FBT return required. Like I said, though, I still would insist on doing an FBT return as nil and lodging it as nil, because the tax office don't know this. They know the company's got a car, but they don't know if it is under or over the 1,000-kilometre private. By doing the calculation, by doing the nil tax return, it sets the tax office mind at ease, and it gives us some, be able to sleep well at night that we've done that, and in 3 years' time we don't need to worry about it anymore. I'll do another discussion about that 1,000 kilometres in a sec. If you are doing more than 1,000 kilometres per annum, well, therefore it just becomes like a normal motor vehicle, which is really the third classification of cars. This is like sedans, just normal cars that are designed to carry passengers as opposed to carry a load. Now, with those ones, if you've got one of those owned by your company, you must do an FBT return. No question. It really just comes down to which method we use, the statutory method or the operating cost method. But an FBT return is required. I've done videos on the different types of methods, which ones work best, which ones are good, and things like that. But we still need to go through that whole process. So as you can see, with really any type of motor vehicle now, even with the exempt electric vehicles, we still need to do work, which is a pain for us, a pain for our clients. But unfortunately, if we don't do this, the tax office are going to be coming after us. I just know it. I'm already starting to see the tax office. I think after I did my last video on the tax office warning, saying that, oh, listen, they'll be coming after the logbooks and things like that. Probably in the last 3 or 4 months, I've had the tax office ask for 3 logbooks from clients of mine, where the 20 years before that, I think they'd asked for 3. So they are going to be asking for these sort of basic things a lot more. Talking about logbooks, everyone knows they need to keep one. Although a lot of people with a ute or a van don't. They don't realize they need to keep one. So we'll go through that in a sec, the way we should be dealing with that. But everyone else knows that they need to keep a logbook for and work out what their, basically their business and their private use of that car is. Now, the tax office has all these different, rules regarding, you need to show the purpose of the trip, the date of the trip, the opening kilometre reading, the closing kilometre reading, and things like that. The more information they've asked for, there's more things to get wrong. And there's more things for the tax office to then double check. So they might look at your kilometre reading on a certain day. They may see you've got a car service on that day with a different kilometre reading on it. If that doesn't match up, they throw the logbook out. If you get the logbook wrong, you can't go back and use the statutory method. They just treat your percentage as 0 then. So again, watch the video I've done on that one, because a lot of people know they should be doing a logbook, but they just don't. They come to me at the end of the year and say, Derek, 95% was work. I said, great. Have you got something to indicate that? And they go, no, but I can if I have to. That's pretty dangerous, because I've seen many people do these logbooks after the fact, and it looks pretty obvious that they've done that and things don't tie in. So just be careful. That's a word of warning. Okay, this thing about the reportable fringe benefit. So now, if you work for a not-for-profit organisation or the Catholic education, you're a little bit more understanding what a reportable fringe benefit is. Or if you work for a large corporation and they give you a car as part of your package, and they pay for all the running costs, but they salary sacrifice it for you, you'll understand what a reportable fringe benefit is. Because what they're saying is that you as an employee have got a non-cash benefit. You get to drive a car on the weekends and things like that, and you're not paying for it. Your employer is paying for it. But you've got a benefit and it's worth something. So there's an amount that's calculated that goes on your PAYG summary called a reportable fringe benefit. So let's say you're on a $100,000 salary, but you've had a salary sacrifice car to bring it down to like $90,000. But that $10,000 that you're basically getting as a non-cash benefit has to be shown in your PAYG summary, showing as a reportable fringe benefit. what the tax office actually does, they gross that $10,000 up as if it was a pre-tax amount. So that $10,000 you might have saved in your hand as net, they'll gross it up at the highest marginal tax rate of 47%. So it's something like $18,000 or $19,000. So a lot of people say, well, Derek, why are they showing like $30,000 as a reportable fringe benefit on my group certificate or my PAYG summary, but I only receive like $18,000 or $19,000 worth of actual benefits? Because they gross up at the highest tax rate. What they do with that amount then, the reportable, they add it to your income. You don't pay tax on it, but they add it to your income to calculate other things, such as the Medicare levy surcharge, private health insurance rebates, family tax benefits, childcare benefits, the parental leave, your HEX debt or your help debt, and the superannuation calculation like the Division 293 and the excess contributions. So lots of things get affected because you say, oh, listen, my taxable income's only $90,000, but it's not. All of a sudden, it gets gross up to $108,000, $109,000, $110,000. So all of a sudden, you might be thinking, I've gone under the private health insurance rebate, but you actually haven't. You've actually gone over and further over it. Now, for a lot of my clients that are self-employed, they really don't care about this. They just have the company pay for a car and ignore my pleas to do a fringe benefit tax return at the end of the year. But we have to start doing that because the tax office want to see this now. If they see an employee contribution, that's fine. But if they see an FBT return gets lodged, they want to know who the employee was and what their benefit was. And this is probably more important for people with electric vehicles because they're sort of thinking, well, I bought this car, it's exempt from FBT, 100% of the costs are tax deductible, nothing else to do here. I don't need to keep a logbook. But unfortunately, we're going to have to. We're still going to have to do the FBT calculations, not for the FBT return, but for the reportable fringe benefit amount that we're going to have to put onto your PAYG summary at the end of the year. Sorry to be the bearer of bad news. Okay, the other thing I wanted to quickly talk about is this thing regarding the cars that are designed to carry a load, like utes and vans, and this private, the limited private use that was brought in a few years ago. What the tax office is basically saying, if you've got a ute, traveling between home and work is okay. Nothing wrong with that, because it used to be if you were carrying more than 20 kilograms, which is not a lot, because most tradies and people with utes would be carrying their tools and things like that, they could use the travel between work and home as part of their percentage to work out their private use and their business use. So that's okay. If you've got a ute, traveling between home and work is not considered private. Where if you have a sedan, it is. So like if I've got my Jeep, I drive from my office to home, that is considered a private trip. Now I've done videos on this to work out, how to work out which one is private, which one is business. But basically, from going from the office to home is pretty much always private, except if you've got a ute. That's okay. The other thing the tax office says is, travel that's incidental to employment duties. So say, for example, you have to go and, pick up some, stationery along the way, or you have to go sort of slightly out of your way to pick up a friend or drop off some, sporting goods for someone. It's sort of incidental. It's not really like you didn't go out of your way to do that trip. That's okay as well. And the third one is non-work related use that is minor, infrequent, or irregular. Their example I give here is the occasional use of that ute to get rid of some domestic rubbish or something like that. That's the 1,000 kilometers. So you're allowed to use this ute less than 1,000 kilometers a year only. So, going to, the beach on the weekend or going visit your mum down the coast or whatever like that can only be less than 1,000 kilometers now. If it goes over that, you are now not an exempt motor vehicle. And so this tax ruling came out in 2018, which goes through all this minor and irregular use, but pretty much it made a lot of people very nervous about what their use of their car is. Now, what we do here is pretty much get the employee to sign a declaration. Now, in most situations, the employee will be the owner of the business or a family member or someone like that. They sign a declaration that basically says, I, Derek Nolan, of employee whatever, for the FBT year 23-24, drove motor vehicle CTW, was it 91K or something? And there's a declaration there between home and work. Any diversions between home and work were less than 2 kilometers. No more than 1,000 kilometers in total with travel, which was private for the year. And no single journey was more than 250 kilometers of a private nature. Now, if they sign that, we're all happy. It now becomes an exempt motor vehicle and we don't need a logbook. So that's what I'll be asking for most people, if they're happy to do that, to do. Some employees, though, genuine employees, may not sign that. So it'll be interesting to see what happens if that happens, because then we've got a problem. But that's how I think we're going to get around the design. The cars are designed to carry a load. Just do this declaration for every vehicle. I've got a client that's probably got 90 work vehicles for the employees. We're going to have to get 90 of these out and get every employee to sign them sometime in early April. Again, just a reminder that FBT only applies to vehicles registered in the company's name. That's the first thing. Because a lot of people, I ask them, do you have a car registered in the company's name? No. Yes, maybe. Like, they don't know. Go and find out the first time. That all the expenses may be being paid by the company, but actually go and find out where the car is actually registered in the company's name. All right, so some key dates coming up. So the end of the financial year for Fringe Benefits Tax is the 31st of March 24, so in a couple of weeks' time. The FBT return due date, if this is the first time your company is doing an FBT return, it'll be due on the 21st of May 24. If you've previously lodged an FBT return, you'll know whether you've gone through the whole thing with me. It's due on the 25th of June 2024. So we've got a little bit of time to get all this stuff done. It's nice because it's before the end of the year. We can then concentrate on doing all the tax returns again. I think that's probably why the FBT return is like that to the end of March. Maybe when they first brought it in back in 1997, they were thinking us accountants to be able to, do this before the end of the year. So they're the key dates. So this is the process that we do here in the office on getting an FBT return done. We'll be doing it again for 2024 with a few tweaks this year. So firstly, what we're going to do is we're going to be sending out just a questionnaire to all our clients, just confirming the number and the type of motor vehicles that their company owns. I think we'll be asking for the registration plate, and that's about all. But we'll be asking whether they're an electric vehicle, they're a utility or van, or a sedan. That's all we're asking for now, because what's been really good for tax over the last few years is this instant asset write-off and the full expensing. So a lot of vehicles that were purchased in the last 2 or 3 years were written off 100% in the first year, which is great for tax. But the problem we have now is they're sort of gone. They've slipped through the radar. They're not on the balance sheet anymore. They're not in the tax return depreciation. They sort of get forgotten about. Now, sure, there's expenses going through the profit and loss for motor vehicle expense, but like I said, a lot of clients, even though they put motor vehicle expense through the company, the car is actually owned by them. And then we end up calling that a motor vehicle allowance at the end of the year, but not as a motor vehicle expense. So we have found that a number of clients, we've sort of lost track a bit of how many cars that they do have. The other thing too, of course, is that we're still doing the 2023 tax returns for a lot of clients. This is FBT's up to the end of March. So there's another 9 months where clients may have bought motor vehicles in that period of time that we're not aware of, or they may have sold some motor vehicles in that period of time, which we're not aware of. So it's what we decided this year. We haven't done this before. We're sending out an email to all our clients, just asking them to confirm the number and the type of motor vehicles they have. Now, if you get this video, I'll get that email from us, and you don't have any cars, that's fine. Just send us a response saying there's no motor vehicles. We just want to cover all our bases to make sure that we're asking the questions to everyone. Based on the results we get from people, we'll then start having to do a calculation on the running costs of those cars for the Fringe Benefits year. Now, for most of our clients now, we have access to the MIB, their Xero, their QuickBooks, their Wave, all their other data files. And it's good now because most of those data files can run a report from the 1st of April to the 31st of March. So the next few weeks, we'll be able to start running those reports and looking at all the motor vehicle costs that go in there. Things like, I do notice clients putting there things like tolls and parking and things like that, which really aren't motor vehicle running costs. So we'll probably take a few things like that out. And then there might be situations where there might be 2 motor vehicles, one owned by the company, one owned privately. So we have to try and separate those. So we'll do a little bit of work then to go through the data files of our clients to make sure we've got a fair representation of what the motor vehicle running costs were from those dates. It's much better than it used to be. You used to have to run a report for the period of 3 months of the year, from the 1st of April to 30th of June, and then run another report for the 9 months of the year. But now most of the data files can run it for the whole period. And then we break it down. Really, we're looking at the fuel registration, insurance, all those sort of just normal running costs, and taking out the things like the lease payments, the tolls, the parking, all those other things. Even though a lot of people think the lease payments is a motor vehicle running cost, they're not. They don't come into the calculation. We're just looking at the fuel registration, insurance, and all those sorts of things. So we'll do all that. The next thing, once we've then identified the type of car that you've got and the running costs of that, we'll then need to come back to you and get a logbook or a percentage. Now, I'm not expecting everyone to start sitting through or mailing through their logbooks, but I do want from the clients some sort of indication of what their private percentage use of those cars are. Like I said, for most of the utes that we've identified, we'll probably just be going with the employee stat declaration and not worrying about the private. That's why we thought we'd do it in 2 steps. Get the type of cars first, but then only deal with the sedans and the electric vehicles. Most of the utes will just treat as being exempt. We still need to do the declaration and the calculations based on Xero. So then we'd have to look at getting from our clients some form of percentage. Whether you send through the logbook, you've kept it, but we do need something back from you. Once we've done all that, so we have, like, if you watch the videos on how you calculate FBT, there's the normal running costs, fuel registration, insurance of a car, but then you have to calculate what they call the deemed depreciation and the deemed interest on those cars. The interest, whether you finance it or not, it doesn't matter. With the cars, whether you've written them off for tax purposes, it doesn't matter. So you might have bought a car in 2022 under the instant asset right and wrote the whole thing off. The whole $50,000 gone. But for FBT, we have to consider that that's still there and being depreciated at 25%, whether it's gone or not on the original cost. So all these things start adding up to the calculation of the FBT, but we'll look after all those things because we'll have that information. Then we do the calculation of either the FBT payable or the employee contribution. Because like I said, most people end up going with the employee contribution, but we'll give people the option, but most of the time will be a case of, well, this is what the employee contribution needs to be to bring the FBT back to nil. And then we'll lodge the tax return as nil, and then item 6.1 of the company tax return, we show that employee contribution as being an income item. Plus, we'll also have to work out the reportable fringe benefit amount, and that's particularly for the electric vehicles and for any other vehicle. And then when the year end rolls around, the 30th of June for the single touch payroll, we need to go and stick that in the single touch payroll as a reportable fringe benefit for those employees. And we'll do that calculation under the operating cost method, and the statutory method, and see which one works out the best. Depending on the percentage of the private, one might work out better than the other. We'll do the calculation on both, and you obviously take the best result. And then finally, we'll prepare the employee declarations and all the supporting documents and lodge the FBT returns on your behalf. So I'm just sort of giving everyone the heads up. One is that how important FBT is. I know I talk about it every year. I do lots of videos on it, but when it still comes down to it, most people put their head in the sand regarding motor vehicles. But what I'm saying now is that the tax office will be all over this. And there'll be some situations where we might do a 2024 FBT return for a client, but we may actually go back and do the 23, the 22, the 21 even, maybe even further, because we do have a potential problem there if the tax office comes along and wants to do an audit of it. At least by lodging them now, we sort of cut that period of time of the audit process down. So there might be some clients we do multiple FBT returns for. All right, well, that's all I wanted to talk about. Again, go and watch the other videos I've done on how we calculate FBT, but I guess the big takeaways is particularly the electric vehicles and things like that. All right, that's all I wanted to talk about today. Make sure you go and look at my other videos. I'm sending this video out to a lot of my clients who may not even know I do these videos for the first time. So go and check out my website if you haven't done that already at 12.com.au and see what other videos there might be worth interest in watching. All right, thanks for watching and goodbye for now.